Video start. Visual opens with a rapid-fire montage. Flashing red charts. Declining revenue graphs. Overdue invoice notices. Volatile stock tickers. Music is tense, minimal, and driving. Narrator, voiceover. Revenue streams may appear strong. Sales figures may show growth. Yet, profitability may stall. Growth may plateau. Capital depletion may accelerate. B-roll, quick cuts of complex, downward trending financial graphs. This represents a common operational failure. Profitable entities often fail to scale. They mistake operational activity for structural architecture. B-roll, overhead shot of a complex, failing machine. Many firms treat finance as accounting. They view it as historical reporting. They manage past performance. B-roll, close-up shot of ledger books and calculators. This approach is insufficient. It is reactive. It manages the residue of decisions already made. B-roll, hands sweeping away dusty historical documents. Financial strategy is not bookkeeping. It is proactive resource architecture. It is designing the mechanism that generates sustainable profit. B-roll, architectural blueprint overlaid with flowing lines of data. Today, we examine the limitations of linear growth models. We build a framework for financial discipline. This framework moves beyond mere tracking. It demands foresight. B-roll, time-lapse shot of a complex structure being built. We will cover 4 critical pillars. Pillar 1, Revenue Optimization. Pillar 2, Cost Structure Deconstruction. Pillar 3, Risk Mitigation Modeling. Pillar 4, Capital Deployment Pathways. B-roll, clean, sequential graphic display listing the 4 pillars. We conclude with a case study. We apply this framework to a real-world scenario. This information is for strategic review. B-roll, transition to a clean, minimalist graphic display. Title card, Financial Strategy Framework. #####2. Core Value Pillars. Time marker, 1:30. Narrator asterisk. We begin with the top line. Pillar 1, Revenue Optimization. The objective here is not simply to increase sales volume. The goal is to maximize customer lifetime value. B-roll, animated graphic showing a long, curved customer retention graph. We must also maximize average transaction value. This requires a shift in focus. The attention must extend beyond initial acquisition volume to the long-term retention value of the client base. B-roll, split screen showing a high initial purchase versus repeat purchases over time. Analyzing the churn rate is fundamental. We must identify leakage points within the customer journey. These points represent immediate, quantifiable losses that erode the base. B-roll, heat map graphic highlighting areas of customer attrition. We must meticulously map the upsell and cross-sell funnels. Do not assume incremental revenue simply because the product exists. You must quantify it. Model the potential lift based on historical data and predictive analytics. B-roll, flowchart animation demonstrating the movement of a customer through different product tiers. Next, address pricing elasticity. This is a critical determinant of margin. Determine the optimal price point relative to the true demand curve. Overpricing deters demand, creating friction. Underpricing sacrifices margin, devaluing the asset. Precision is required. B-roll, graph demonstrating the relationship between price point and demand volume. The strategy here is tiered service modeling. Structure offerings in distinct good, better, and best tiers. This systematic approach directs the customer towards self-selecting a value proposition that increases the average spend per client. B-roll, visual representation of 3 distinct, escalating product packages. Transition **** optimizing the inflow of capital is only half the equation. The subsequent phase requires a rigorous examination of the outflow ***. B-roll, smooth visual transition from rising revenue charts to descending cost charts. Narrator ***. Pillar 2, Cost Structure Deconstruction. The focus shifts from merely tracking costs to active cost elimination. We must move beyond simple expense reporting. B-roll, a financial analyst reviewing a dense spreadsheet, highlighting specific lines. The foundational framework for this discipline is zero-based budgeting. Every expenditure requires mandatory, demonstrable justification. No line item is exempt from review. Every dollar must justify its existence and its expected return on investment. B-roll, graphic illustrating the concept of ZBB, starting every budget item from zero. Review operational expenditure. Identify systemic vendor leverage points. Status quo pricing should never be accepted as a given. Renegotiate terms aggressively. Seek volume discounts or alternative service providers. B-roll, shot of a negotiation table or a contract being revised. We must examine the entire supply chain. Inventory holding cost represents latent capital decay. Implementing lean models is essential to reduce carrying costs and optimize working capital cycles. B-roll, animated diagram showing a streamlined, efficient supply chain. Analyze labor costs rigorously. Assess automation return on investment. Calculate the true cost per unit of output, factoring in both salary and overhead. This analysis reveals structural inefficiencies. B-roll, split screen comparing manual labor processes with automated machinery. Transition ****, a lean cost structure provides stability. But stability is meaningless if the system is exposed to unmanaged risk. B-roll, visual transition from a stable graph to a depiction of storm clouds gathering over a market. Narrator ***. Pillar 3, Risk Mitigation Modeling. This pillar addresses systemic vulnerabilities. We must move beyond basic insurance coverage. We are modeling the probability and impact of external shocks. B-roll, complex, multi-layered risk matrix graphic. The first step is comprehensive stress testing. Subject the entire financial model to extreme, hypothetical market downturns. Determine the operational threshold where the firm becomes insolvent. B-roll, animated simulation showing a financial model failing under pressure. Next, implement robust diversification strategies. Do not concentrate capital or revenue sources in a single market or commodity. Diversification is a mathematical imperative for resilience. B-roll, graphic showing multiple, non-correlated asset classes spread out. Furthermore, establish clear liquidity buffers. Maintain readily accessible, liquid capital that can absorb unexpected operational demands without forcing a sale of core assets. This is the primary defense mechanism. B-roll, image of a secure vault or